Welcome back. We're joined again by Rob Wessel. He's managing partner at Hamilton ETFs and a former Bay Street bank analyst, this time to talk about what the rest of the Canadian bank earnings season could look like and his view of valuations in the sector after the banks have experienced a long-awaited rally in their share prices, as we showed you before we went to break with that view of the TSX Banks Index. What are some of the themes that you'll be watching for as the rest of the banks roll out their results?
Yeah, I mean, so right now, as you pointed out, stock prices have gone up quite a bit. I think they're up 40% in the last 12 months. So the banks are not cheap anymore. They traded 12 times fiscal 25. So there's been a lot of multiple expansion. So even though consensus has them rising 5% a year, I think it's fair to say the market is thinking it's going to be more than 5. So if you think about, okay, well, what is this quarter going to tell you and how to get more than 5 for next year? You know, there's really a couple things. The first one is the Canadian economy has to get moving, whether that comes from a change in government and change in fiscal policy or whatever it is. It's very hard for national banks to move in any country when GDP is mediocre, which for Canada it is. That's number one. Number two is, can provisions start to fall? So they've been, gross impaired loans, provisions for credit losses have been rising for quite some time. Eventually they're going to peak and they're going to come down. Probably part of that is already built into market expectations. Then the third thing is, right now, with the group, 4 out of the 6 Canadian banks have a fairly significant issue impacting their valuation that is unique to them. In almost every instance, it relates to either a capital deployment or some sort of regulatory issue in the case of TD. So how they get resolved is all going to be, it's going to be one big mismatch for 25.
So that group, that last group that you spoke of, those that are who are facing unique issues, TD obviously is one. Is Scotia another with this capital deployment?
Yeah, I think so, yeah.
Are those the two that fit into
then
that?
National and BMO, right? National buying Canadian Western Bank, and then BMO struggling to get Bank of the West, the biggest acquisition in Canadian bank history, getting that acquisition moving and doing much, because it hasn't been doing very well.
So how should we understand the credit picture right now? Many Canadians are renewing mortgages, for instance, at higher rates than they took them out 5 years ago. However, the Bank of Canada has been notching rates down.
Yeah, I don't know that that's going to be the driver. Mortgage loan losses are generally de minimis, even though the portfolios are large, in part because of mortgage insurance. So moving to the rest of the portfolios, if you look at historically, right now, their provision ratio is like 50, 55 basis points. Historically, it's 40. Good times, it's 30. So there's a lot of credit leverage ahead of you if in fact, you can turn the page. But again, the Canadian economy has to do better, and some of these foreign platforms have to start performing better.
Your view of the Canadian economy is interesting. You don't think you don't think the economy, you cited either a change in fiscal policy from the current government or a change of government. You think the Canadian economy needs some type of catalyst. Yeah,
well, whether I think it is, if it gets a catalyst, that will be very positive for the sector. But, overall, capital is good. Allowances are quite high. The balance sheets are very robust. So really, they need to get earnings moving. But again, there's two things going on right now. Valuations in absolute sense are quite high relative to historical, especially given how the banks are performing, which is okay. And then you also have very significant dispersion. So, you have RBC and National with huge premiums. You have TD and Scotia with large discounts. And then you have BMO and CIBC in the middle. And so the market's pricing in some fairly big outcomes for everybody. And how some of these things play out is going to have a fairly big impact on relative performance.
What's your view of National Bank buying CWB, Canadian Western Bank?
Listen, it was unprecedented insofar as the quantum of the premium and at that time the amount of time to close. But in an absolute sense, the valuations were reasonable, and it's an in-market acquisition. It does improve the demographics of the bank. The key for National Bank is they have a large ROE premium, which supports their PE or valuation premium. If they can sustain that and they can execute well, then National Bank will continue to be an outperformer.
It's interesting. If we just flip back, there's Canadian Western Bank, and you can see when National announced this acquisition. If we just go back to National, it's very interesting to look at the market reaction and then what has happened since then. What happened was these shares were put on sale, and people who bought in mid-June or so have done well since then.
Yeah, absolutely. And I mean, CWB was trading at an extremely low multiple, which explains why the premium was so high.
What's your take on Royal Bank of Canada, which has been the star performer this year?
I mean, it's arguably the world's best bank, so it's priced like the world's best bank. So they've done extremely well. They have a great strategy outside of Canada, and insofar as it's very diffuse or diversified. They're not reliant on one massive acquisition, and they're executing extremely well, including HSBC. So the challenge with RBC, if you own it, which probably everybody does or should, is it's priced like it's 13.5 times, which is a huge premium over the rest of the group.